Welcome to this episode of Damien's Market Update. Now, as ever, if you find this useful, please do make sure you hit that like button on YouTube and subscribe to the channel. If you're listening to this as a podcast, then do leave a review and also subscribe to the podcast through whichever app that you use. And also, as ever, if you've got any questions, leave them in the comments below the show and I'll get back to you. So at the end of June, it brought to a close the first half of 2023, which was a period in which equity markets performed strongly. And if you look at the NASDAQ composite in America, it was driven by prominent tech companies like Apple, Amazon, Microsoft, Nvidia, Alphabet, Meta, and Tesla. And it experienced its best start since 1984. Apple even reached a valuation exceeding $3 trillion, and Nvidia tripled in price due to the investor enthusiasm for AI stocks. But it wasn't just the NASDAQ that was being propelled higher by investor enthusiasm for tech and AI. As an interesting exercise, if you go and chart the equal weighted S&P 500, so if you get your iPhone app out and you search for SPXEW in the stock app and you put that against the S&P 500, you will see that the former was up just 4.88% in the first half of the year versus plus 14.9% for the latter. Now, this beautifully highlights the influence of these tech giants have on the wider US stock market returns. The stock market rally caught many investors off guard, with investment banks' end-of-year targets for the S&P 500 being surpassed already. And yes, we could still see a market correction later in the year, which would result in those predictions being proved correct. But many banks have already thrown in the towel on their original predictions and they've torn them up and revised them higher. But if we look beyond the US and the influence of AI, the rally in global stock markets has been heavily influenced by the predicted divergence in monetary policy around the world. So generally speaking, the closer investors believe a given central bank is to the end of its rate hiking cycle, the better its domestic stock markets have performed. And that's been bad news for the UK stock market. Among the winners, however, ignoring the US for a second, has been Japanese equities. Now, while the central banks in most other countries have committed to raising rates to combat inflation, the Bank of Japan has stood apart by maintaining negative interest rates, which is why it has been such a strong performer in local currency terms, at least so far in 2023. European equities also experienced strong gains in the first half of 2023 as investors anticipated a slowdown in inflation, but also that the European Central Bank would slow down its rate hikes and they would in fact reach their peak. If you look at the France's CAC 40 and Germany's DAX, they reached new all-time highs in the beginning of 2023, but the UK's FTSE 100 lagged due to the persistent high inflation and also falling oil prices. And it means that in local currency terms, the NASDAQ composite rose 31.73% in the first half of this year compared to 26.25% from the Nikkei 225, 15.91% from the S&P 500, 6.59% from the German DAX, 4.11% from the emerging market index by MSCI, 3.05% from Asia ex-Japan, and then we have the FTSE lagging there with 1.07% for the first 6 months of 2023. But interestingly, if you listen back to that, it's almost a list from the most dovish or least hawkish central banks out there down to the most likely to keep raising interest rates for the foreseeable future, and that means the UK. You have to remember that the impressive equity market rally in the first half of 2023 also occurred against a backdrop of conflicts, banking crises and debt ceiling negotiations in the US, and investors bought every dip in equity markets, which demonstrated the increased resilience, the increased resilience compared to 2022. But up until now, I've talked a lot about stock market returns in local currency terms. The reality is that the strength of the British pound due to the Bank of England's more hawkish stance when you compare it to other central banks has created challenges for UK investors and continues to do so. If you factor in the rally in the strength of the pound, you can knock off around about 5% from most of those year-to-date stock market returns I quoted earlier. And that is the impact of currency market moves and is why your portfolio returns won't match the local currency numbers that I mentioned earlier. Yet the value of the pound has surged even higher in the last week after lower than expected US inflation data sent the pound above $1.30. So that is a threshold we haven't seen since April 2022. And UK investors are now relying on the rise in the value of overseas assets to be sufficient enough to offset any losses caused by the stronger pound when you actually convert the overseas asset value back into pounds. In addition, the stronger pound always poses a challenge for the FTSE 100, and that's because approximately 80% of the constituent companies within that index derive revenues from overseas, particularly the US. It's one of the reasons why the FTSE 100 has been one of the global laggards since the spring. So in conclusion, many of the investment themes, concerns that have lurked in the background over the first half of 2023 remain. That's things like corporate earnings concerns, Chinese growth fears and geopolitical worries. In addition, the fear of further rate hikes is trumping the fear of recession in bond markets, causing yields to rise in recent weeks. If you'd looked, you would have seen the 10-year US Treasury yield was back above 4% in the last week, but it's actually fallen a bit. Remember, when yields rise, it means that the value of bonds falls. But overall, we're heading into the second half of 2023 with the same nagging concerns that haunted markets at the start of 2023 before equity markets rallied strongly. The only difference now is that more and more investors have returned to the market, chasing the equity market rally. Or, in other words, greed is now trumping fear. If you found that useful, please do make sure you hit that like button and subscribe to the channel. And as I mentioned at the start, do leave any comments or questions in the section below this video.